Hi guys. Today we will analyze Kroger stock and calculate its intrinsic value using two different valuation models. Enjoy. Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. In the past year the stock was a good performer in the market. The long and short-term trends are both positive. Support levels are around $55 and $49.50. Strong support levels are around $47, $43.50 and $40. Resistance level is around $58.80. In the last month the stock has been trading between $44 and $62.40 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 8.5 million. This is a good sign as it is always nice to have a liquid stock. The stock is currently showing a bull flag pattern. A bull flag pattern occurs when prices pull back slightly after a strong rise up. This may be a nice opportunity for an entry. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 4% per year, for last 5 years. We see that the average profit margin of the stock has been around 2% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 107% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Kroger Company: bad, average, and good. First scenario. Kroger will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 1%. Future free cash flow to net income rate would be low, 40%. In this case, the fair value of the stock today would be $38. Second scenario. Kroger will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 1.2%. Future free cash flow to net income rate would be average, 50%. In this case, the fair value of the stock today would be $59. Third scenario. Kroger will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 4%. Future profit margin would be high, 1.5%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $91. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.68. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Kroger, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 15. Again, I will use 3 different scenarios for Kroger Company: bad, average, and good. First scenario. Kroger will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 13. In this case, the fair value of the stock today would be $21. Second scenario. Kroger will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 15. In this case, the fair value of the stock today would be $26. Third scenario. Kroger will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 17. In this case, the fair value of the stock today would be $32. As you can see, today the stock is overvalued, $55, even if we expect the company's high performance in future. The financial health of Kroger is medium. Also, its profitability is quite bad. While showing a very small growth rate, the stock is too expensive at the moment. I may consider buying the stock when the stock drops below $40. Company's strengths. Kroger operates about 2,700 retail supermarkets and multi-department stores in 35 states. The company also operates 137 fine jewelry stores, 1,600 supermarket fuel centers, and 33 food processing plants in the U.S. The company has pharmacies in about 82% of its food stores. While Kroger benefited from high demand for groceries as COVID-19 spread, the company has excellent prospects after the crisis, helped by affordable private brands, strong customer analytics, and a growing emphasis on fresh foods as well as by online ordering and curbside pickup. It continues to use big data to drive successful promotions and merchandising decisions. Many shoppers will continue to use the online services after the pandemic fades. This is supported by the company's customer research. Kroger has a portfolio of successful private brands that is growing faster than national brands. While Kroger doesn't match Walmart on price, it typically has fast checkout times and good produce and prepared foods. Over the years, Kroger has done an excellent good job of offering fresh and organic products to satisfy its core customers and keep them from venturing to Whole Foods. Risks. The grocery business is highly competitive and margins are notoriously low. Walmart and Target appear to be gaining traction and investing heavily in their online ordering and delivery capabilities. Amazon has raised the bar on expectations for shipping and delivering products, and this is forcing Kroger and others to invest more. Kroger's stores are more suburban and Kroger does not have stores in the Northeast. The company must be very skillful in executing its operating plan because margins are so thin. Labor relations are a constant risk for Kroger because about 75% of the company's employees are covered by collective bargaining agreements that are negotiated by unions. Healthcare and pension costs are likely to be key issues for some time. Kroger's return on assets of 2% is worse than the rest of the industry. It has a return on equity of 11%. This is below the industry average of 14.7%. Its profit margin of 0.75% is below the industry average of 1.5%. Kroger's net debt-to-equity ratio, 120%, is considered high. Kroger is expected to show a small growth in revenue. In the coming 5 years, the revenue will grow only by 4 to 6% yearly. The earnings per share will grow only by 2 to 4% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.